give a little bit of a short background on some of the areas that we're researching and focusing, and Tony's going to talk about some of the really cool stuff that he and his company are doing with the application of AI. And then after that, we really just want to open this up for questions, so try to make this as interactive as possible. Sound good? All right. Thank you for that introduction. You know, with the macro trends group, what we do is our role is really to look at the intersection of technology along with macroeconomics, demographics, macro-social, geopolitical trends, and how they all intersect. So they all intersect in the real world, so we have to think about them, how they intersect as we think about the future for many of our clients. And as we have been thinking about artificial intelligence among other subjects, what really jumped out to us, the aha moment, is to understand how artificial intelligence, and I'll put this a little bit more broadly, automation, the next wave of automation, sets in the context of some pretty profound demographic changes that are happening here in the US and worldwide, and also socially the patterns of income distribution, income and wealth inequality. And so what we really see it playing out is this interplay between demographics, automation, and inequality, and it's really that dynamic that in our view helps create a more complete picture over what's happening. So let me describe a little bit of what that picture looks like. Demographics is changing. Demographics is like watching ice melt. Nothing happens very quickly, but when it does, it creates lasting and profound impact, and you can see an environment and a macro condition pretty far out with a fair degree of reliability. And long story short, we have basically gone through probably one of the fastest growth periods in the fastest labor force growth periods in the history of the world. Massive amount of growth, partially because of the baby boomers, but also the integration and globalization of China in particular, as well as India and some other parts of the emerging economy. Really great, never to be repeated, at least not in our lifetimes. And so we're starting to make the transition, and all else being equal, we should be moving into a period of labor shortage. And that's going to be sort of the initial condition that we're looking at. And normally what that would do is that would help raise the price of labor, that would help reduce the levels of inequality. It would basically undo a lot of the trends that we've seen over the last 30 to 40 years. And then comes automation. And this is where we see automation, call this an economist way of looking at it, but it's both a push and a pull. So from a technology perspective, it's the push, which is it's available. But from a business and an economics perspective, it's also being pulled. Labor shortages are what will make the business case for automation, for the adoption of artificial intelligence, for machine learning, for all of these different technologies. That's what will make the business case, and that's what will speed adoption, commercialization, and ultimately macro impact. And what happens in that? There's two things. One, you get a tremendous amount of investment needed. Our estimate, about $8 trillion cumulative worth of investment in total needed in the United States. That involves a lot of training, a lot of reshuffling. And what's happening underneath the surface is that you're essentially starting to make a large portion of the workforce obsolete. And it doesn't mean that they immediately become disemployed. It just means that you're now setting a new benchmark price. Do I pay a person this much, or do I automate at that point? It creates a new cap on the wage market, and that worsens the inequality. All that goes, the investment booms, the investment busts, like all investments do. And now you have all of a sudden a tremendous amount of capacity, income inequality, reducing purchasing power, and a dramatic imbalance in the overall economy. And that takes us, in our estimation, and this is orders of magnitude, so please don't quote me on this, but about, call it 2030. And it's really navigate for us, for our clients, as we think about what does that mean for the workforce. I think it really begins to set the table for not just thinking about artificial intelligence and automation as a single shot, like we go from here to there. What we're really thinking about is how do you navigate through a very complex transition path. At the end of the day, is artificial intelligence, machine learning, robotics, all of these different forms of automation going to make the world better? Probably. I'm not a techno-pessimist or a Luddite. But as we look at the pattern of history, it's, yes, things always ended well, but people forget that at some point there was a transition, Those transitions are actually, can be 10-year, 20-year time periods. And quite frankly, if you're alive today, if you're sitting around, the transition is what we're going to be living our lives through. So it's great that in the long run it's going to all work out. What we need to think about is how to navigate through that transition. So from a labor force perspective, and I'll take this from a lot of different perspectives, and it'll be helpful to get your questions. From the perspective of, let's say, employers who are thinking about their workforce, one of the things that this is going to create is this is going to accentuate and exacerbate some of the existing scarcities and abundances within the workforce. So scarcity for very top talent will actually become even more severe. And then on the other hand, you're going to have an increasing pool of talent of lesser skilled workers who are facing even more profound commoditization. And then as a business owner, both in terms of how you want to run your business and how you're looking at the marketplace, it is that tremendous divergence that you're having to deal with, not only as perhaps as an employer, but also for any customer or consumer-facing business. This is your customer base, right? An increasingly bifurcated base. We've thought forever about this idea of the middle class, right? Like kind of the middle 60, 70%, and then you have a little bit of a richy rich on top and the challenged on the bottom. But it's a very sort of three-tier way of looking at the world. If you look at who's getting affected by automation, not just disemployment, but also what I would term rate or wage repression, that's about 80% of the 80% of the workforce. Only about, in our estimate, only about 20-25% would be directly disemployed at some point. But 80% is facing basically a cap on their wages. So it's an 80-20, roughly an 80-20 market, both from an employer's perspective, but also from consumers. And then let me just take it very briefly from the other side, which is if you are, from the perspective of an individual who, I mean, we all, myself, all of us included, we participate in the labor market side of things as well. How do you navigate that? To be perfectly blunt, it's the pressure to be in that 20% is even more intense. There are a lot of skills. People say, like, well, what specific skills? Is it creativity? Is it certification? Is it technical? Is it STEM? I think that's a little bit too narrow a way of looking at it, but in general, as you think about artificial intelligence and listen to all the speakers here, is artificial intelligence, machine learning, service sector robotics, all these things, they can do tremendous things. They also have a lot of limitations. So find the places with limitations, because there's a lot of limitations. I mean, gosh, Tesla's having a hard enough time trying to get a car plow onto the back of a semi-truck, right? So there's actually a lot of room for humans to be. But the problem is we've never had that pressure, because for the last 20, 30 years, we've had plenty of people and we've thrown more bodies at the problem, and we've gotten in some sense very lazy at being strategic and focused in where we ourselves and for children and for the people that we influence, how we direct them to think about that career path. So let me stop there and turn it over to Tony.
Thank you. Before I get into it, I'll just take a continuation of what Austin said, tell you a story from my company and how what we're seeing on a day-to-day basis dovetails with his observations. And then I'll go into complete intelligence, what we do, why we've done it. So we do market forecasts, okay? We do economic and trade forecasts, that sort of thing. And we were sitting with the head of research for a global natural resources firm. This was about 4 months ago. And we forecast bills of material, raw materials, these sorts of things for people, prices and volumes and stuff. And when we showed him what we do, afterward he said, wow, I have 70 people on my team, and if I work with you, I could actually cut all of them, okay? These are highly skilled people with graduate degrees, very cosmopolitan, very smart, very mathy, very everything that you would think would be a survivor in this type of economy, right? But the type of work that we're doing will cut out 70 highly paid, highly skilled people. And within 2 or 3 years, those jobs will be gone, okay? If you're a forecaster in a global firm, if you're an Excel jockey, those jobs are gone. I'm really sorry to say it, but anything algorithmic can be eliminated within, I would say, 2 years, not 20, 30. I think that's a bigger, bolder vision. but I think some of these internal mid-level jobs will be gone within 2 to 3 years, okay? So with that happy note, let me take a step back and kind of tell you what we do and why we do it and how we do it. So I used to lead global research for a company called The Economist. I did a lot of economics and market work for them. I then moved to a company called IHS, which is a big global information firm. They do oil and gas work and economics and all sorts of things. I came to a point a few years ago where I love the narrative that these guys tell. They tell great stories, but the data that you find in markets and in economics generally, and when I say generally, I mean always, reverts to consensus, okay? Everything is consensus reversion, okay? And so what I wanted to do was to build a firm that was based on data, not a firm that's based on narrative, okay? So we have 3 principles at Complete Intelligence that we built our business on. The first is an integrated global model, okay? We started building an integrated global model. It's multi-layered based on trade, economics, and markets, okay? And if you have, let's say, an activity in one country, it will impact the crude price or the gold price or a currency or whatever in other parts of the world, okay? As far as I know, there are only 3 models that work this way. 2 are at universities, and 1 is private sector. It's a very high level, okay? So integrated global model is the first one, okay? Second one is 0 manual intervention in our forecasts, okay? We have no judgment whatsoever in a line item forecast of what we do. If you look at any analyst firm, there is always manual intervention in the forecast, always. The problem with that is you cannot isolate error, okay? And if you're going to truly take an AI approach to markets, you have to be able to isolate that error so you can improve the approach going forward. So how does this manifest itself? The first success we had was in 2015, okay? We were forecasting a bill of material for a global manufacturing firm. It had a lot of things in there, but the one that I remember the most was crude, WTI, okay? So I assume some of you guys know the oil and gas market. So at that point in June of 2015, crude was trading at $68. The consensus view was $80 by December, okay? We were presenting to 120 of the global supply chain team for this global manufacturing firm, and we told them that WTI would be trading at $46 by December of 2015, okay? The next day they fired us because we were so far away from consensus. By December of 2015, crude was trading at $42. They hired us in January of 2016. So, those are the kind of non-consensus views we get by really letting the machines do the calculations and not biasing the outcome, okay? Taking it more current, if any of you follow currency markets, in January of this year, we were telling people that the dollar would stabilize in April, appreciate in May, and accelerate in June. I was on CNBC talking to a global currency strategist about this. They told me I was foolish. They laughed at me. They said we're in a weak dollar environment for the next 2 years, okay? And what happened? Dollar exactly stabilized in April. It accelerated in May, or appreciated in May, accelerated in June, okay? So had we gamed the model to consensus, we never would have achieved this, okay? And so what are we doing? Okay, so that's the kind of manual intervention. Everything is done by the machines. Any changes we make are systematic. And then the last one is the user interface. So our user interface is extremely simple. So if you look at our user interface, you probably think it's a stupid product, okay? And this is the thing with AI that I think many people, they want the implied complexity of the user interface to believe that there's something complex going on. But as we have more sophisticated AI products, you talk to Alexa and say, can you do ABC? And she comes back with 6 questions, not understanding what you're doing, right? But that user interface becomes more and more simple as you have more sophisticated activity on the back end, okay? So I think as AI matures, the people who do it won't have to imply that complexity in the interface because they'll have solved all the problems on the back end. And that's what we've wanted to communicate to our clients. You can use our interface, you can figure it out in 30 seconds, you can get your data within 2 clicks, and so on and so forth. So those are the 3 things that we've done as a business, okay? And so we have about 15.5 billion data items in our core model. We run about, well, tens of millions of algorithms every month. We refresh them every month. So we retest and reweight all of our algorithms for everything that we forecast every month. So if you're in financial markets and you're running a model, most of these models have algorithms that are at least 2 years old. You refresh the data, but you rerun the same algorithm. Everything we do is reweighted, retested every month, okay? So you have the most current view on what's going on. The way people are using that is to look at their raw materials costs, to look at their bills of material, to understand risk in currency markets. People are using us to forecast their sales and so on and so forth, okay? And what they're finding, we have a big German electronics firm as a client, electronics manufacturer. And in May, we had a discussion with our sales forecasts. And for Q1 of 2018, our error rate was less than 3% for the 7 countries and 9 product lines that we had forecast, okay? By the time, sorry, that was 5 countries. By the time we got to the 4th country, there was a larger discrepancy in some of the product lines, and the finance head looked at his team to ask them for error rather than questioning us about our error, okay? And so that's the power of, you know, these tested, error-minimized, algorithmic approaches to doing this stuff. So we'll get much more sophisticated as we go forward, but if you look at what we're doing, you know, we're enhancing capability, okay? Firms don't do the type of bill of material forecasting that we're doing. Monthly interval, understanding the risk, the direction of pricing. Very few firms do that, okay? There's the resource kind of reduction. How many people would it take to do that? And so these 70 people within this natural resource firm, that's a lot of people doing forecasting, right? And so, you know, coming to us to have us do that can really minimize the resources and put those people on higher value things, right? And then the other part is adding new capabilities. So we have one of the largest food companies in the US who uses us, and they're looking at our forecast saying, look, we would love you to add a risk layer to this so we can understand the risk of the forecast as well as the historical risk with what we've done. And then we add components in there to understand where their error is internally. And so I think a lot of the AI type of work that we're doing is in not just identifying our own error, but clients are increasingly coming to us to find out where their error is in fixing that. So, how's that?
Sounds good.
Good? Okay.
Sounds like I'm going to be out of a job.
No. You've got too much going on.
Alexa, please write me a presentation.
Right, exactly.
Yeah, I don't know if you want to, we might just want to open up to some questions, or we can talk a little bit more. I mean, one of the things that struck me in your initial example, I love that example because it is so striking, exactly the way you frame it, which is these are folks who you would look at and say they shouldn't be concerned, right? They should be part of the 20%. And part of our analysis in coming up with the 25%, which I know sounds like wonderful consultant, make round numbers, but is actually looking through every job category for every industry and then asking ourselves, like, actually, that's a really easily automated, right?
Yeah.
And it's scary how many currently good middle-class jobs are actually incredibly easy to automate, and a lot of them are actually information data oriented already. The physical side is a little bit trickier. The relationship side is a little bit trickier. But you look around, I mean, big pretty buildings up and down 75 freeway filled with people. What are they doing? Probably a lot of information processing.
Excel and PowerPoint.
Excel and PowerPoint, exactly. And so that is a little bit of, call it the social challenge and the social shock that we see coming, which is the people who are likely to be automated are not the ones who I think the average person suspects is at risk, and that just only makes it even more disruptive. And these are, again, a lot of jobs that are really considered right now the backbone of many middle to middle upper class So how do you navigate through that transition? So in some cases, those 75 people will go off and they will get leverage from this technology. They'll migrate. They'll focus on more interesting things. How much can you do that? That's really sort of the question. Because at some point, yes, in the long run, the economy will adjust. In the long run, we're all dead anyways. So how long does that take? And if you look at the speed of transition, and we looked back to the 1900s, to the agricultural to industrial revolution, to see just how fast, if you scaled the population then and the size of the workforce of the population today, how many people could you really reabsorb? And it really works out to about 700,000, about maybe 1 million people per year. When you're talking about a speed of dislocation that's at least twice that. And that's a little bit of the challenge, which is people are not fungible. It takes real people sit in a class for a semester, right? A semester hasn't in some sense gotten any shorter with technology. And so it takes a real amount of time for people to adjust, for families to adjust. How do you navigate through that? And that's a little bit, I don't have an answer to that, but in some sense, that we think is going to be the pressing economic, social, technological challenge.
But I think that's right. And I think one of the impediments to this person who said he could replace 70 jobs didn't do it, okay? Because he likes managing 70 people. And so, you're going to have,
Like that.
right, exactly. You're going to have that type of resistance. And so our biggest competition is internal. Our biggest impediment is internal, where people understand what we do very clearly, and it really scares them. So you can either choose not to participate and have someone above you make that decision, and then that's terminal for you. Or you can choose to engage and be a part of it, and be a part of that decision and part of that solution, and help those 70 people do something else, rather than have that decision come, let's say at the beginning of the next recession or something, when nobody has any other choice, and labor market competition is very high, right? And so, I think part of what we're trying to do is go to people and say, look, these are decision tools. They can help you today. That 70-person replacement didn't come out of our mouth. That came out of their mouth, okay? I was also with the deputy head of sell-side research for a global bank. I had the same conversation with him. He said, I can't work with you because then I wouldn't have a job. Like, this would replace the job of me and my team, okay? So there is real fear from really smart people about what we're doing. And I want to be clear, the goal of what we're doing is not to replace jobs. Like, that's not our purpose as a company, okay? We're trying to create better outlooks for markets so companies can minimize risk. That's really what we're trying to do. But it's the people inside of these companies who realize the efficiencies that can be made, and they're the ones raising concerns about jobs.
With that in mind, would you say that it's possible that highly adaptive small and mid-sized firms have an advantage in terms of they have less transition friction? They may have a different investment profile, but the cost of a lot of these technologies and availability.
Yeah. Look, we've built this company over the last 3.5 years. It would have cost us a lot more, even if it was just 5 years ago, okay? And the ability to take modular technologies and build something new. So we don't use things like IBM Watson because we have all our own IP, okay? But if you're a company and you want to bolt on something like we're doing or something like IBM's doing or whatever, you can do that. And as a small company, you can really enhance your capability. You can really enhance what you're offering to your clients, okay? And so I think, the view of AI has to be one of an enabler, not necessarily one of a carnivore of jobs, right? It really has to be one to enable more capability.
So one of the things I'm curious about, though, is most of the optimistic views are that AI augments, right, humans, and that's the positive. But those same views say that it's the judgment is kind of the niche, Austin, that you mentioned, that requires a human. But it sounds like you guys are in a position where you're actually taking out the judgment as well. So where's the line between the human needed judgment and the consensus is just
I guess a lot of the question is around what is an acceptable level of error, right? Humans don't track their error very well at all. And we are uber accountable for the error that we have. We tell on ourselves, okay? And so, you know, and when we sit with a client or a prospect and we say, look, here's our error rate, and here's how we performed in 2017, high-low trading band, here's where our forecast was, you know, that sort of thing. And they go, oh, you had, you know, 6.5% error on average. And I say, yes. I want to ask them, actually, what was your error rate, right? Because they just don't track it. On average, let's say crude price forecasting, our error rate on average is, say, 4%, okay? Average error rate from analysts using old methods is 15 to 20% or more, right? And so, you know, you really have to benchmark your own performance before you look to automated methods to really question, is 6.5% bad, or is it actually pretty stellar? You know, is 3% bad, or is it actually pretty stellar? So I think what will happen is a lot of people on the finance side or the risk side or the procurement side will get pressure from shareholders to say, why are you so inefficient in your buying process? Why are you so inefficient in your revenue planning process? You know, every company, the way they plan revenue, CFO comes out with one view, head of sales comes out with another view, and then it's negotiated, right? The way people are using us is to say, okay, here's all of our CRM data, okay, sales data. You run through it, it's millions of lines of data, and then you run it through your process and you tell us what segments we're going to sell into, how much we're going to sell by country, and so on and so forth. So we play that middle ground where, you know, it's not the CFO saying, I've got to satisfy the board. It's not the head of sales saying, well, I got all these guys telling me they can't do it, right? So it's that, you're right about the judgment, but I guess the subsequent question there is, how much error is acceptable with that judgment?
And I think also, Tony, you have the advantage of targeting a market where there is a tremendous amount of structured data to work with.
Yeah.
And this is a little bit of this is the eventual promise of things like Internet of Things and trying, you know, digital everything. I mean, you know, there didn't used to be a physical digital way of looking at how people have social relationships. Well, now we're talking about LinkedIn or Facebook or whatever, right? There's an actual physical manifestation, bits and bytes, that show that, you know, you are friends with so-and-so. That didn't exist before, so now you can start to do things with it, but that's still, there's a large portion of the physical universe that doesn't really have good structured data around it, which could then be used for these systems. You know, and a lot of the automation, we think, is really the place where automation is, where it's been missing, where the technology hasn't been able to affect it, is really within the service sector. And you think about within service sector, what is service sector? Economic analysis is certainly a high end of it, but really a large portion is retail, restaurants, and high-touch healthcare. Right, like those are really the big portions. That's where most of the workforce is migrated.
Just piggybacking on what you said about structured data, I would say a large portion of the effort is in sourcing and validating data itself, okay? The process itself, actually not that big of a deal. Yeah, it's sophisticated and everything else, but once you get that rolling, it works. You tweak it and everything else. But sourcing that data, finding that data, validating that data, you know, let's say you have a database of, you know, 2 billion items, and then 3 of them have alpha-coded cells where there should be numeric cells. It'll mess up everything, right? I mean, that sounds really mundane, but that's where the trick is in these very mundane processes of figuring out, you know, where errors are within data. How do you search that out, and how do you fix that? This is really, you know, problematic. Mm-hmm. Mm-hmm. The stuff from the head of sales? We don't. So we take stuff out of CRM, and a big problem that we find, say we'll take information out of a CRM or ERP system. I think that the promise of the whole big data revolution is it's been about data storage. I don't know that it's necessarily been about data utilization. And so we'll get data from people that is just really hard to use. I think if companies haven't taken a serious look over their data governance over the past 10 years, they really have to now. Otherwise, that is a serious competitive disadvantage. You know, structured data, you know, there's a view on structured versus unstructured data, and I think structured data is the easiest kind of data to work with, and since it's the easiest kind of data to work with, if you're a company, you might as well make sure that it's good data, because then you can report on it and make decisions based on it. Yes?
Talk a little bit about tools for AI and search capability and something centralized, decentralized, enterprise.
Do you want to go first?
Sure. So the question was, is it, I mean, really how centralized or decentralized are the AI tools going to be?
Yeah.
Kind of the crux of it. So what we're seeing is, okay, I'm the macro guy, so let me back up a little bit. Two big roles. So there's platforms, and then there's the folks that use the platform. So there's kind of the underlying technology. You can think of it everything from Amazon Web Services, and Azure as a bunch of their tools, and IBM is working on has had Watson. And those are just kind of the more brand name ones, right? But these are fundamentally generic platforms. And then you have companies like Tony's who are really honing in on, this is not a generic tool, this is something that is finally honed for a specific use case, which is, as he said, is very proprietary, right? I mean, clearly that's going to be the case. And this is going to be the, you know, if you were a software company, this is the business decision, which is do I ultimately think I've got something that can be a platform that everybody can use, but that's really just sort of, generic toast, or do I have something where I can develop a very finely honed application for a particular use case or set of use cases? And in between, which has traditionally been kind of the realm of a lot of software, which is the kind of customized but kind of off the shelf. It might be, some of you might know, like Crystal Ball is a Monte Carlo simulation software. It's kind of specialized but kind of generic, right? And that's actually the sort of the new donut hole in the market, which is it really doesn't solve anything. It's not precise enough to trust. But it's not generic enough to be able to act as a fundamental platform. So that's really, centralized, decentralized, yeah, both, absolutely, because those are going to be two very different types of markets.
My view, it's a little bit different. I think this generation we're in is highly centralized. Alexa goes back to a centralized database and function. Our stuff goes back to a centralized database and function. I think as you decentralize, it'll have to do with the level of contextualization needed for the application of that data, okay? And I don't believe we're there yet in terms of highly contextualized data. Of course, you have all the personalization and that sort of thing, but even that goes back to a centralized database. I don't think you'll necessarily have those decisions made kind of at the end point for at least 5, 8 years. But right now, everything's highly centralized. Why? Because it's new technology. Everybody wants to know what and how you do it, right? Nobody asks how a PC works anymore, right? But because that's a mature technology. Nobody asks how the internet works anymore. But with this sort of thing, people, we get a lot of very detailed questions about how it works. And I think that's true all around. People have to trust the core before they can trust the endpoint. And over time, we'll get to the point where the endpoint is where you get that high contextualization and processing. Sorry, wait a minute. You've been raising since the very beginning. We'll get you next, but you've been raising since the very beginning.
So it was helpful to hear you talk a little bit about the maturity of AI right now. How do you view dealing with unexpected traumatic events, like things that impact global markets, 9/11, financial meltdown? Do you have enough history to say when an event of
this sort happens, here's a different model that, or the model will
Sure.
change, and here's a path we've seen in the past, and it may be close, it may be far away, but, probably better than the old path that we're on.
Yep. Okay, so I used to, when I was going around to Asia 10 years ago for The Economist, I'd get this question that said, how do you forecast a black swan? And it's really not forecastable, right? And so I think where we are today, we develop non-consensus views. Well, we're happy if it aligns with consensus. We don't have any issue with consensus, but we have views that come out that are non-consensus, right? But we're working with one of the exchanges in Asia right now, and in May of 2017, iron ore out of Australia spiked, I think, 300 or 400% in 1 month. Okay, very similar thing happened with certain cuts of beef in the U.S. around the same time period. And so we've been working with a food company here in the U.S. as well. Very similar problem. How do you forecast a 300, 400, 500% spike in a market in 1 month, and then it calms down 2 months later? We have a statistics professor over here who may be able to tell us how to do it. We haven't quite figured out how to do that yet, given the interval of what we're working with, okay? Now, what we'll eventually get to is a sum of, let's say, 30-minute forecasts that go to a day, a week, a month, a year, okay? But those methods are very different. And so we're trying to get Gen 1 out and commercialize Gen 1, and over time, we'll be able to run those things. But we have done very well at understanding where markets are going in a fairly non-intuitive way. But these things, so questions we get all the time, how do you account for political risk, okay? How do you account for weather risk? Those are the two biggest ones, okay? For political risk, so political risk forecasting right now is terrible, okay? There is no political risk firm. I know of two, one in South Africa, one in India. But there's no major political risk firm out there that forecasts the Trump election, okay? There's no major political risk forecaster out there that forecasts Brexit. The two biggest events in OECD countries over the last 10 years, after the financial crisis, everybody missed it, okay? So we don't include political risk. Our view is that really currencies iterate political risk better than the political risk forecasters. And so that's how we look at that. Weather risk really is supply chain risk, right? More than anything, it becomes about supply chain. And so we can layer in weather data, but here's the problem with weather risk. You may have high level relationships over time or high correlations or whatever with certain types of weather or certain type of events, but do you trust the weather forecast, right? We're not weather forecasters. Weather forecasters aren't even great at telling me what's going to happen in 4, 5, 6 months. So if I layer a flawed weather forecast into a forecasting engine, I'm going to introduce more error than is already in there. So we already account for seasonality in our models. And so, in our view, there's really not a way to forecast, Hurricane Harvey last year. It's part of the hurricane season. It happens. You get these spikes, and we talk to clients about this stuff and say, look, there are times when you just need to hedge. You just need to buy a hedging instrument and work on it that way.
Yeah, I want to tee off of the geopolitical and the GI, because that has been a very, very hot topic with a lot of our clients. And but I don't disagree with anything that you said. But the point about no major political forecasting firm forecasted either of the two biggest political events of the pretty much this decade is true, but at the same time, nobody had it as a majority case. There's a non-zero possibility, and this is a little bit of right. But and I'm not playing semantics, but this is a little bit of the challenge, particularly with geopolitics, which are so non-repeatable. Which is, if there's a third, whatever, if your business heavily depended on Trump versus Clinton, and there was a 30% chance that Trump would win, which something kind of got up into there. What do you do with that? 70% chance, quote unquote, 70% chance that Hillary will win, but not non-zero that that Trump would win, and your business highly depends on the outcome, right? Like maybe you're very trade dependent, and this matters a lot to you. What do you do with it? And this is a little bit of the integration challenge, which is you can develop the view, the forecast, maybe geopolitical event forecasting will get a little bit better, but at the end of the day, you get that number, and then as a business person, what do you do with that? I mean, you brought up the point of hedging. That's actually one question. How do I make myself, fundamentally, how do I make myself less sensitive to the geopolitical risk, or any risk, macro risk, recession risk, dollar risk, the things that actually matter. And that becomes the business strategy, the next sort of layer past, which is how do you actually take that information, take some sort of a view, maybe it's produced out of an AI engine like what Tony is doing, and then how do I do business differently becomes the next question that I think a lot of business people have to ask themselves.
Let's go to our friend here. Sorry about that.
Yeah, so my question was around data and training your AI. And what I was wondering is, as far as finding good data, of course, is kind of essential to do with proper training. But if you find that you have data that's not really deterministic of outcomes, do you usually trim that stuff out, or do you actually continue to feed your AI with that information in case of those dimensions or those factors become deterministic in the future? Do you have to keep changing, how things change, or how do you guys manage your basic training?
To be very honest, I would say we don't really know yet. I think, when you look at, let's say, the sugar market, okay, if you're a sugar trader, what data are the most highly determinative in the sugar market? Actually, it's like silver. Silver trades, very interdependent with sugar trades, okay? Not every month, okay, not all the time, but the silver market and the sugar market are very highly related, okay? Now, because our model is a closed model, we treat the world economy as a closed system, because it's interdependent, our view is that that's meaningful, okay? We hear people talk about spurious correlations all the time. I just don't have time for that, okay? Because if we had flat spreadsheet models, I get it, okay? But we have an integrated global system, and we can actually think through the value chains of these things and understand why these things are related if we look deep enough, okay? So we haven't got to the point where we're saying that's really not valuable data. Now, we're not putting in baseball scores, that sort of thing. And these are economic variables and market variables that we're putting in, okay? We wouldn't really put in astrology or baseball scores or something because we don't believe that that's material to markets. We may be wrong, actually. We may be wrong. But if it has to do with markets, we're trying to get all of that stuff in there so we can understand what impacts that price. Yes, sir.
So we saw numbers this morning about unemployment projections. What I heard you said was there's, going to be 50% of jobs that will be displaced will not be replaceable because the alternative will sort of dwindle. So I'm curious, wasn't that, as I play that out, that means it's permanent unemployment. Isn't that ultimately damaging to firms? And I'm curious if your models, if you've looked at that, what are some of the scenarios there?
So specifically around the employment situation?
Right, for the long term.
Yeah. So let me start by just setting the table in terms of some of the basic anchor numbers. Of the labor force, we think that ultimately about 20 to 25%, and I use the term disemployment, not because I'm playing word games, but a good example, if Amazon opens up a bunch of convenience stores that are fully automated, and ultimately in the marketplace that displaced whatever, a Quick Trip or a 7-Eleven that would have gone in there that was less automated, then those are jobs that would have been created in an alternate universe that are not created here. So and that's why I specifically use the term disemployment. They still ultimately affect the balance of the labor market when you look at it at the macro level. The other number that the other percentage I threw out there was 80%, which is as we look at jobs that will either be directly disemployed or face the challenge of wage repression or wage ceilings because of competition from automated alternatives. That total will be about 80%. In terms of how that actually shows up, and this is why kind of seeing it over time is important, the reason why you get that 20-25% is, mathematically, if the economy just grew, then you could absorb all of that labor. I mean, and this is kind of the optimist argument, which is it's just going to simply facilitate, wonderful, better things, more everything. But as we look at specific, product by product, market by market, some things don't really expand all that much. So if the price of annual physicals from your doctor went down, would you have more of them? I don't know. Most of us are pretty good with that, right? Like we're dentist cleanings. Just because the price drops doesn't mean all of a sudden you're going to be in there every day, right? There are in fact, and we see this in our retail practice. A lot of our retailers talk about quantity saturation, especially for a lot of durable goods. So the problem is some things will expand. So will people use possibly more of other healthcare services, wellness things? Will people eat out more often if the price were to drop? Yeah, those are areas where markets will adjust relatively quickly. But there's a lot of things where if there's more of it, we're just not going to need that capacity in the near term. And that's really where you get that 20 to 25%, which is the theoretical capacity exists to just have more of everything. But that's in theory, in real markets, business by business, everybody's looking at it and saying, if I were to automate, would I be able to keep all these people and just expand my sales? Or is the reality, that's my market, this is my new cost structure, so I need to hire 25% less people. And that is a fairly common scenario for business setup that we see through a lot of the service sector, through retail, even through healthcare. Same thing. If you think about healthcare, by the way, that's another one where we haven't talked about it in this particular context, but we look at it, right? The cost of healthcare, the debt, Medicare, unfunded liability, all that stuff. How do you square the circle? Because in some sense, the market at some point ultimately has to square, and the only way to do that is to achieve a radical reduction in the unit cost of delivery. How do you achieve that? You ultimately have to double the human productivity of a lot of the healthcare sector. How does that happen? Ultimately, it's through automation and robotics.
I can add to that. I mean, look, it's the capital versus labor discussion. If you're going to invest in the capital, there's going to be a trade-off with labor. It's that simple, I think. So I think people will still work, of course. People, there's always a job. There's always something to do. People have demand for new things. So I'm not really pessimistic on the job market. I think I'm actually not pessimistic on the wage gap. I think there will be things to fill. I don't think, of course, it'll be the same form as it has been for the last, say, I think the last big major disruption in the workforce was probably in the early 90s when we had like 13% unemployment or whatever, and you had mass layoffs, and companies started re-interviewing people every 3 months to keep their jobs. I mean, the global financial crisis was big, but I don't believe it was as big in terms of work culture as that was. Okay, I think, I think it's fairly straightforward, and I think there will continue to be, I love this book, Humility is the New Smart. When I sit with a client and they expect me to defend our forecast, I'm not defending the forecast, and I'll tell them, look, we have an error rate put into this, so I'm not gonna, the hypothesis is the underlying process. The hypothesis is not the forecast number, okay? So I can't, if we think, Brent crude is gonna be at 79 bucks, I'm not gonna sit here and defend the forecast of 79 bucks. What I'm gonna talk to you about is the approach to getting there. And I'm gonna say there's a 7% possibility that we're wrong on that within our high, mid, low forecast, Okay, so I think you start to have more of those types of discussions with people, and I think my approach is less arrogant than it was humble. I would say when I was an economist, I was more arrogant and confident about my numbers than I am today. Because we're so deep in the data, we understand the error inherent in anything that we do. And that's how companies operate, right? Companies operate within a margin of error in everything that they do.
I want to come back to a comment that you made at the very beginning in regards to 25% of the workforce across the economy being dislocated, 25% job elimination among staff members. Then you talked about reassimilation over some period of time as AI changes the way we work. The statistic you cited was a little bit different. I think you mentioned something about 1 million workers coming back in the workforce for some period of time or increment of time. Are those two things comparable, or did I misunderstand the way you were describing that?
Yeah, I mean, just to kind of step through the numbers, if you scale the disruption in 1900 and 1940, so this is basically the automation of agriculture and the migration of people from farm to factory, our version of that. Over that time span, if you scaled the population, it would work out to roughly 1.2 million people displaced each year every year for a 4-year period. And it's funny, if you see the way that that story actually plays out, the absolute level of employment didn't change all that much. The economy happened slowly enough that the entire economy grew around it. So the way I kind of intuit it is the mom and dad stayed on the family farm and just kind of rode the thing out, but all the kids basically left for the city, and that's how very practically the economy adjusted. If you look at what we're seeing coming up, it is both broad because the service sector covers it's impacting such a wide swath of the labor force. And orders of magnitude, if I were to ask you, do you think this will be faster, slower, or about the same as the agricultural revolution, agriculture to industry movement? Generally, people will say, same or faster. We're a faster economy. Okay. So it works out to about 2.5 million people displaced each year every year over a much shorter time period. And it's that problem, which is you have such a large portion of the economy being affected versus, let's say, manufacturing automation back in the 70s to 90s. And then the pace of the economy being able to adjust to these things is much faster. And it's starting to reach the limits of people's ability to literally adapt.
We're at the 5-minute mark, so take an additional question or two.
Just to follow up on that real quick, so from an economic standpoint, is there a thesis on the economy being able to sustain a higher level of unemployment as a result of automation? You talked about the leveraging benefits to the average individual from these technologies. Is there a view that we're going to be living a higher unemployment level society, economy that's sustainable because of the benefits of technology?
So this is where we start getting into a little bit of the social speculation, which is generally when there's enough disruption, people stop looking at markets and people start looking to the government. And that is not an inconsistent thing if you look at some of the other patterns of social patterns, to put too fine a point on it. So there are ways of fixing the situation as you get into that. And a really simple one is you can simply change the length of a full-time work week. Very magically, the numbers fix really fast. I don't know, 4-day, 3-day work week might not be such a bad future after all, but it's not something that the market in some sense is naturally going to just produce by itself. Typically, at some point, the economy becomes so imbalanced that you need some outside action, and that's typically the government to start adjusting rules in order to get everything back to functioning. This is not an advocacy of any particular position. Let me be clear, we are nonpartisan. We do not advocate any position. What we are trying to do is we're doing our best to predict or project potential scenarios for how reality might actually transpire, regardless of whether you like it or not. All right. How about, I guess, one more question?
So I guess, what kind of people do you have in your firm, and what advice do you have
The type of people I have in my firm are pretty resilient all-rounders. They go deep in certain areas, but they're very creative. So we have our analytics team in the UK, our technology team in India, our marketing team in the Philippines, and our sales head in Singapore. And so we started as a global company from day one. And I think, people can't necessarily rely, and this is an old discussion, but I have people in my company who I've met 4 times, and I've worked with them for 3 years. And so, but I talk to them at least 3 times a week. And so, I'm going to where I can get the best skills and the most cost-effective skills to get this done. And so, now, of course, there's a team here in the U.S. as well. So, but generally, we're looking for the best skills and the most cost-effective skills. And so, I think what's really key for people, and those 70 people, both for my team and for those 70 people, you have to, regardless of how much of an expert you are, you have to be able to communicate. You have to be able to empathize across cultures. You have to be able to empathize across job roles, okay? Very difficult. Those 2 things together are very difficult to find, okay? I think especially for those 70 people, their best position would be to embrace the technology, embrace the change, see it as a productivity uplift rather than a mutual exclusive replacement activity, right? It's not either or. It can be a productivity enhancement, and it can make them incredible, right? So they can move from a forecaster to, strategist or whatever. I don't know exactly what that step would be, but it's taking these pretty mundane forecasting things and turning them into something that, instead of spending, say, 2 weeks to adjust their model, they could run 40 different scenarios over that time. Or they could run 40 different scenarios in one day, right? So they can understand what will change those futures and how they, intercept those futures better. So again, I don't necessarily see that much job destruction. I see the skills changing to where you can better be in the path of and intercept those future alternatives. And so I think those 70 people need to be able to think more in a more agile way and use those skills in a number of different ways. Rather than understanding the numbers, they're going to have to understand the events, okay? The precursor events to those things happening, how the impacts impact the organization, that sort of thing. So they're really going to have to understand the whole value chain of what they're doing, not just the numbers.